Ladies and gentlemen, good day and welcome to Capacite Infra Q4 and FY24 earnings conference call, hosted by IIFL Securities Ltd. As a reminder, all participants' lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anupam Gupta from IIFL Securities Ltd. Thank you, and over to you, sir.
Yeah, thanks, Siju. And it's my pleasure to have Mr. Rohit Katyal, Executive Director with Capacite Infra, to discuss the fourth quarter and FY24 results for Capacite Infra. To start off, I'll hand it over to Mr. Katyal for the opening remarks, and post which we can have a Q&A. Over to you, sir.
Thanks, Anupam. Good morning, everyone. On behalf of Capacite, I welcome everyone to the Q4 and FY24 earnings conference call of the company. Joining me on this call is Mr. Rajesh Das, our CFO, Mr. Alok Mehrotra, and Mr. Nishit Pujari, along with Marathon Capital, our IR team. I hope everyone has had an opportunity to look at our results. The presentation and press release have been uploaded on the stock exchanges and our company's website. As we conclude FY24, we are pleased to report a period marked by significant achievements, including the highest ever revenue and profitability both during Q4, FY24 and the whole year. The higher execution has helped us in better absorption of fixed costs, thereby leading to improved profitability. The capital raised during the year has been strategically deployed to strengthen the execution across projects. Over the past few years, while our order book size has expanded significantly, our projects under execution have reduced, leading to higher revenue contribution per project, better management, and improved margin profile. We are embarking towards a higher growth phase, backed by our diverse order book from distinguished clients in both public and private sector. The execution across projects has seen a marked improvement, and we believe that the pace should further improve. We remain committed towards improving our working capital cycle and profitability. With strong financials along with our execution progress, we are confident of setting up new performance benchmarks in the years to come, starting 24-25. Other key updates: the company achieved highest ever quarterly and annual turnover and profit after tax. We firmly believe that the momentum should continue. Successfully raised 200 crores by qualified institutional placement in Q4 FY24. The raised capital is being strategically deployed to fuel our future growth and fortify our operational capabilities, allowing us to deliver exceptional value to our clients and stakeholders. Projects awarded during FY24 stood at 2,009 crore excluding GST. Consolidated performance highlights for Q4 FY24. Revenue from operations for Q4 FY24 stood at 599 crores, up 34% as compared to 447 crores in Q4 FY23. EBITDA for Q4 FY24 stood at 121 crores, up 41% as compared to rupees 86 crores in Q4 FY23. EBITDA margin for Q4 FY24 stood at 19.8% compared to 19.1% in Q4 FY23. EBIT for Q4 FY24 stood at 99 crores, up 69% as compared to 58 crores in Q4 FY23. EBIT margin for the same period at 16.2% as compared to 13% in Q4 FY23. PBT for Q4 FY24 stood at 73 crores, up by 97% as compared to 37 crores in Q4 FY23. PBT margin for Q4 FY24 stood at 12% as compared to 8.3% in Q4 FY23. PAT for Q4 FY24 stood at 52 crores, up by 139% as compared to 22 crores in Q4 FY23. The PAT margin for Q4 FY24 stood at 8.5% as compared to 4.8% in Q4 FY23. Consolidated performance highlights for FY24. Revenues from operations for FY24 stood at 1932 crores as compared to 1799 crores in FY23. EBITDA for the year stood at 363 crores as compared to 361 crores in FY23. EBITDA margin for FY24 stood at 18.5% as compared to 20% in FY23. EBIT for FY24 stood at 262 crores as compared to 225 crores in FY23. The EBIT margin for FY24 stood at 13% as compared to 12.4% for full year financial year 23. PBT for FY24 stood at 167 crores as compared to 136 crores in FY23. PBT margin for the financial year 24 stood at 8.5% as compared to 7.5% in FY23. PAT for FY24 stood at 120 crores, up by 26% compared to 95 crores in FY23. PAT margin for FY24 stood at 6.1% as compared to 5.3% in FY23. Gross debt stood at 326 crores as compared to 370 crores. Net debt for the year stood at 69 crores with net debt to equity at 0.05x. Order book on standalone basis stood at 9,011 crores as on 31st March 24. Public sector accounts for 69%, while private sector accounts for 31% of the total order book. Now the floor is open for questions, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ranodeep Singh from MAS Capital. Please go ahead.
Thank you for the opportunity. Congratulations on a great set of numbers. My first question, sir, can you give me a flavor of the order wins expected in FY25? And will the ratio of public to private change materially in FY25?
Yeah, hi, morning. You see that the opportunity is very strong both in public and private sector. However, private sector, given our experiences, we will be sticking to those quality of clients which we are currently working with. So more or less, the order bifurcation between public sector and private sector would remain 70-30. That's point number one. Point number two, the bid pipeline across the geographies where we are operating is extremely strong. So it is an opportunity to pick and choose. I firmly believe that all better placed contractors, including Capacite, have an opportunity to improve upon the margins going forward in the future order wins. So that is our take as far as the mix is concerned.
Sure. Thank you. So my next question, Mumbai has emerged as the data center capital of India. Any order wins or business developments in that aspect? And more so, if you can share what's the playbook in that domain, given Mumbai has the concentration of data centers.
So the company is already executing 13 data centers for defense across cities. That project is scheduled to get completed by August, September in the current financial year, which will give us serious qualifications. Having said that, the company has bid for a 700 crore data center, and we expect the opening soon after elections. And hopefully, it was a tender on which three parties, including L&T, Shivcare, and Capacite, were qualified. So let us wait for that outcome. But yes, we do see a big opportunity there. We have tied up technical collaboration for the main components already, and we do believe that this technical tie-up will give us a serious opportunity in the current year and the years to come in the Tier 3 and Tier 4 data center business.
Sure, thank you. If I can squeeze in one last question. You did share in the last call guidance for 25% growth in FY25. Is it safe to assume, given the traction that we are seeing over the last one quarter, we see a 25% growth trajectory for the next 3 years?
That is our commitment to the clients, minimum commitment. So we have to grow at that level. Given what we have done in quarter 4, 600 crores, 2,400 crores is given for the current financial year. Even if we believe that we may lose some momentum during monsoon, and then again gain serious traction in quarter 3 and quarter 4. But as things stand today, 25% minimum growth guidance is here for sure.
Appreciate that, sir, and did see your presentation on the list of clients that you built over these last 3 to 4 years. Wishing you all the best for the next few financial year. Thank you.
Thank you very much.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Vikas Agrawal from Istoma Investments Advisors. Please go ahead.
Yeah, hi sir. Good morning.
Hi.
Congratulations on a good set of numbers.
Sorry to interrupt you, sir. May I request you to please use your handset?
Yeah, I am using handset only. Am I audible?
Oh, a lot of disturbance, please.
Yes, sir. So can you come near to the mic and speak, please?
Okay, let me try. Is it better now?
So there is a lot of background noise from your end.
Okay, let me come back in the queue again.
Sure, sir. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Anupam Gupta from IIFL Securities. Please go ahead.
Yeah, thanks. So the question is firstly on the balance sheet side of it. So if you look at the working capital, seems to have expanded at least when you do a YOY comparison. I understand there is a quarterly element to it, but if you can maybe give a picture of how you see the working capital changing over the next whole year or so.
You see that the revenue expansion has led to an increase in debtor, which is a normal cycle. The collection for the quarter will get reflected on quarter-to-quarter basis, and we do believe that there is a strong case for a reduction in the net working capital by nearly 20 days in the current financial year.
So when you say 20 days, in the sense if I take the average revenue if I take the full year revenue and use this as a base, I see a very high working capital cycle. But on normalized basis, what is the number you are looking at? If you can maybe give a sort of a quantum for that.
You see that the total working capital, basically expansion is on basis of 2 points. Number one, the increase in debtors in quarter 4, which has increased by about 150 crores as quarter 3 24. All right. This is a one-time phenomenon. The revenue is going to grow at 600 to 700 crores approximately per quarter, and therefore these numbers will only come down on an enhanced revenue base. So what I'm trying to say is that the net working capital historically of the company has been 97, 96 days earlier, and we intend to come back to that level in the next 4 to 5 quarters.
Okay. Understand. And the second question is if you can give an update on both the CIDCO project as well as the MADA project in terms of what is under execution, what will incrementally come and under execution over the next year.
So MADA project, the order book considered as on 31st March, our share in the project is 4,500 crores plus escalation, which works out to maybe 5,500 crores or so. At the moment, the order book recognized is close to 1,500 crores, and the order and the work is in full momentum. 14 buildings have been handed over to us. Plus, in the current quarter, close to 5 commercial towers have been handed over to us. Residential towers. Now, these residential towers are 80 stories each, and therefore the work will start on these from quarter 2. So we do see a serious expansion in revenue from MHADA project. As it is the last financial year, MHADA, we have done close to 250 crores in revenue, with a chunk of that about 70 crores coming in quarter 4 alone. So we do see an expansion in MHADA revenues in the current financial year, and the same expansion will continue for the next 2-3 years minimum and the foreseeable future. Coming to CIDCO, we have done a revenue of CIDCO over 372 crores for the full year 23-24. We do believe that the revenue to be done in the current financial year will be somewhere close to 600 crores.
Okay. And now, so all the 7 sites are under execution, so there's no thing which is left to start.
The 7th location is yet to start, but that is better because the client also is in process of selling the apartments which are already coming up. But we do believe that by July, August, that location also will start the execution. So as we stand today, the extensions available are till 26 March. The 7th location, as and when it comes in, a suitable extension will be granted by the client.
Okay. That's all for my side, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Parvez Qazi from Nuvama Group. Please go ahead.
Hi. Good afternoon, and thanks for taking my question. So 2 questions from my side. In terms of order intake, what is, let's say, the quantum of orders that we will be comfortable taking up in, let's say, FY25? Fresh orders.
So we are looking at 3,000 plus crores as we stand today. It will be reviewed, obviously, with comparison to the revenues done in the first half year of the current financial year. And then we could decide to increase this number suitably. But as we stand today, the minimum order intake guidance can be taken at 3,000 crores plus.
Secondly, for the MHADA project, you mentioned that we did about 250 crore revenues in FY24. So what is, let's say, our target for FY25 for this project?
So at the moment, given the work fronts available, we are looking at about 350 crores. But then you have to realize that there are all the projects currently being executed by the company offer a revenue potential of average 10 crores per month. Okay? So even if that reduces by, let's say, 15-20 crores or increases by 15-20 crores, the revenue guidance will stand.
Lastly, in terms of our debt levels, where, let's say, do we see them by the end of next year, FY25, let's say?
So our net debt is approximately 55-60 crores at the moment. There is no doubt that we'll be net debt free by the end of current financial year.
Good. Lastly, what was the capex that we did in FY24, and what's the target for FY25?
So the capex which was done in last financial year, 24, was 45.11 crores. We believe that the current year, the approval from the board taken is approximately 55 crores, and we should be at that level only. So obviously there is a serious effort to ensure that asset rotation is higher. We use our own equipment and restrict or do not take such projects where new asset acquisition is very high and disturbs our whole year plan of capex.
Sure. Thanks and all the best for the future.
Thank you.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Hello. Yeah, thank you very much, sir, for this opportunity, and many congratulations for great numbers. So, sir, I've got three queries. You mentioned that in your opening remark that in future, I think our focus will be to improve upon our margins in terms of the orders that we take in future orders. So generally, what is the threshold margin generally we look at whenever we bid for any kind of orders, and how do we see that EBIT margin trajectory over FY25-26 on account of that?
You see that what I meant in my opening remarks was that the future bid pipeline, given the number of contractors and the humongous business opportunity, presents a clear-cut opportunity to all better placed contractors, including Capacity, to expand on their profit margins. Right? It is something that there is more demand than supply, so it will be offering an opportunity. When you come to the building sector and when you talk about orders in excess of size of say 700, 800 crores, you will not find more than 6 or 7 companies in the country who qualify in the government space. So that is a serious opportunity. Private sector will continue to be by invitation, where we are already qualified as practically all the top developers. Now coming specific to Capacity, I had mentioned last year and over again that EBIT margin should be taken as a threshold for comparison, and increase in revenue, whereby fixed costs have remained same or slightly have been lower, has led to the expansion in your EBIT margins. We believe that if the revenue grows significantly, let's say by 25% year on year, there will be a fair chance or opportunity for the EBIT margin to grow on the existing order book itself. Hope to have answered your question.
Yeah, I got it. And what is the range we might be looking at in terms of EBIT margin? I think current year was about 12%, right?
So we are targeting, obviously the guidelines have to be given on historical basis. So 12 to 12.5% is what guidance I can give you. But if something better happens, we should all be happy.
So it can improve upon this level as well, right?
We have improved compared to previous years. Yes, it can definitely happen. We are focused on.
That's very clear, sir. And my second question is, you mentioned, right? Going forward, execution per quarter should be at least 600 to 700 crores in that range, at least.
So 600 crores is given. What I mentioned is that monsoon period, generally, given the summers which we have had, we expect a strong monsoon as well. All right, and in monsoons generally, if you have seen the trend in Mumbai, nothing happens in June. It starts pouring like mad in July and August. So earlier you used to lose 15 to 16 days. Last year we lost 20 to 23 days. So it all depends on how many days are lost due to extremely heavy monsoons. Now, if the normal 20-21 days are lost, we still hope that we will be able to do about 550 to 600 crores revenue in quarter 2. But yes, there will be significant improvement in quarter 3, quarter 4. Therefore, 2,400 crores or 25-27%, whatever that growth number comes to, is given. Anything above that will improve all the parameters and will be good for all the stakeholders.
Great. Yeah, that's very clear, sir. And just my last question is on your debt. You mentioned we look to be debt free by this year end. So what sort of interest costs we might be looking at? Apart from your debt, there are other costs as well that comes.
You see that the company currently has only non-interest bearing advances. The interest bearing advance on which last year we have paid, last year we paid about 15 crores of interest to the clients. That is not shown at the project level, that is shown under the finance cost. And last year that cost was 7.92 crores. We believe that cost should come down to about 1 crore of rupee or crore and a half in the current financial year. All right. Now, the advances from clients are between 8 to 12% per annum, plus bank guarantee costs. The interest from banks are varying between 9 to 12%. However, going forward from H2 current financial year, we believe the finance cost to reduce by at least 100 basis points or more.
by 100 basis point as an interest cost.
As an interest cost.
Okay. So, but do we expect at least the currently, I think this quarter our finance cost was around 23-24 crores, right? So in the second half, this will go to about 18-20 crores run rate.
Total finance cost was 25.61 crores in quarter 3. It has come down to 22.15 crores in quarter 4. In quarter 1, current financial year, we should be at the same level of March 24. Thereafter, you can see some reductions over the entire financial year.
Understood. I got it. That's very clear, sir, and very helpful. That's it from my side. All the way best. Thank you so much.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Rahul Kothari from Grift Equities. Please go ahead.
Hello. Am I audible?
Yes, please. Go ahead.
Yes, sir. I think in the last transcript, you did mention about the intention and the objective wherein we intend to achieve around 800 crore kind of run rate. So is it in any other quarter going like Q3, Q4, we expect to achieve such kind of run rate?
Sir, we have grown significantly in Q4 as compared to Q3. Obviously, Q3 and Q4 are the main, work seasons in India. Even Q1 should be similar. However, we have seen elections in this quarter, which meant lower availability of labor, but we will still be maintaining the revenue guidance, what we have informed you. Whether 800 crores is possible, of course it is possible, but my guidance still sticks to 25% plus. Anything above that, more than guidance on revenue, I am very optimistic on the guidance of EBIT and net profit. We would like to maintain the quarter 4 performance on the full year basis, and if we are able to do that, the company will improve significantly on ROE, ROCE, and also add significantly value to all the stakeholders, including our shareholders who have stood by us relentlessly over the last few years.
Okay, great, sir. Thank you. That's it.
Thank you.
Thank you. The next question is from the line of Mukul Verma from Verma Associates. Please go ahead.
Yeah, hello. Hello, sir. Congratulations on a very good quarter.
Thanks.
I have one question on the depreciation. So depreciation in Q3 and Q4 of last year was 27 crores, which has come down to 22 crores in Q4. So can we expect the depreciation to continue, or it was just one?
I have guided earlier in the earlier quarters also. After having shifted from output to input method of accountancy from 1st of April 22, the depreciation now going forward is bound to reduce, thereby expanding the PBT and the PAT, and therefore the right measurement will be EBIT, as I have been repeating, and that's true for any company, including our company. So yes, the answer is that the depreciation will fall going forward. We expect the same depreciation of quarter 4 to continue in quarter 1 and quarter 2, and thereby little bit drop in quarter 3 and quarter 4.
Thank you so much, and congratulations and all the best.
Thank you.
Thank you. The next question is from the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
So sir, what is the kind of emphasis you will place on now government orders coming in, and this BDD also? What is the chances that we will get the contract for the balance towers also?
So BDD is a single contract of 12,000 crores. So we only add that order book for which land is made available. So in the current quarter, we will add about 800 crores of land which has been made available to Capacity on standalone basis. All right. The second question is chances of getting the whole order. The whole order is with us. The work is going on. I urge investors to do visit that project site and see the enthusiasm in the locals, because we have topped out nearly 3 buildings. We are giving a fabulous a home to those people who was staying in dilapidated houses, and therefore there is no question that the whole project will be executed. We have started strong execution in the current financial year at the LLP level, that is at the SPV level. We have executed more than 500 crores as revenue, which means about nearly 45 crores or 40 crores or 45 crores revenue per month. This will only increase in the current financial year, and therefore we are extremely confident of getting the entire scope as per the original contract, if not more.
And about the government contracts, we feel that we can get some more contracts for hospitals or other metro systems.
Obviously, we are in this business, isn't it? So we continue to bid, but as I explained, that we will be choosy. We have a very large order book. There is no need to go and take any order which disturbs our profit profile at the moment in time. As far as hospitals are concerned, there is huge traction at that level on the healthcare. We qualify on the healthcare segment. We will be completing our first government hospital by August, September this year, which will further strengthen our qualifications to build across India for all government hospital projects. So therefore, yes, whether it is data centers, whether it is healthcare, whether it is residential or commercial, or whether it is retail, the company qualifies in all of these segments, and we will be actively pursuing opportunities in this. We have already guided that we are looking to close the current financial year with order inflow of 3,000 plus crores, which means that the order book would still remain above about 10,000 to 10,500 crores.
If our quarterly execution in, say, probably 2 financial years from today is to rise to around 1,100 crores, what is the kind of inputs you would need from management as well as CAPEX?
Sorry, sir, I have not followed your question.
So just now, our run rate per quarter is around 600 to 700 crores. So if we have to ramp this up to 1,100 crores per quarter, what kind of managerial changes or kind of CAPEX changes would we need, even if it has to happen say 1.5 years from today?
So managerial changes at the top level and the second level are not required. The revenue comes from project side. We have guided that over the next 2 years, we would like to restrict our number of projects to 35-36. Now 35-36 projects, and if each project minimum gives 10 crore revenue, that translates into a 350 crore revenue per month. 350 crore revenue per month translates into 1,050 crore revenue, which you are talking about. But give it some time.
So we will have to have now projects of some ticket size, and so that this 10 crores per project per month can be achieved.
We are already on way to that. That is why you are seeing an uptick in revenue. We built up our stocks. We built up the momentum, and the momentum is here to see in Q4. The momentum will continue. And as I told you, we do not look at the order book. Let's say you have 65 or 70 projects, then the management bandwidth will definitely get stretched. We are here saying that we will be restricting the number of projects to 35-36. Okay, 1 or 2 give here and there, which does not stretch the management bandwidth, ensures that we make going forward 10 crores revenue from each project to go to that goal of 350 crores per month in execution. All right? So therefore, first question was, do we see any management changes? We do not see. Obviously, with increase in number of projects, you will have project teams adding up. All right? That was your question, which you asked me, I guess.
Yeah, I understood very well, sir, and very beautifully explained. Thank you so much.
Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Deepak Agrawal from Param Capital. Please go ahead.
Yeah, good morning, sir. So can you share some updates?
Sorry to interrupt you, sir. May I request you to please use your handset?
I'm on the handset only. Is it audible now?
Yeah.
Yeah.
Please go ahead.
Yeah. So, can you share some updates on the bank guarantee limits? How much are we tied up to fund this kind of growth? And also the second question was on the rating upgrades. Any updates there, sir? Thank you.
So first question, bank guarantee we have tied up 252 crores and 111 crores sanction is in place. So we do believe that by June end, July 15th, the entire bank guarantee limits will be tied up. That's number one part of your question. Number two, our results have just come out today. We will be forwarding these today itself to the rating agencies. Whatever we had targeted, we have achieved that. So, but I wouldn't like to put a date on that immediately. Maybe we will inform you separately, and whichever investor would like to know, they can approach our IR team and they will inform the date by which we expect the rating upgrade to happen.
Great, sir. Thank you so much.
Thank you. The next question is from the line of Darshil Pandey from Finterest Capital. Please go ahead.
Hello, am I audible?
Yes.
Yes, sir. Congratulations on this good set of numbers. First question would be on what is the overall bid pipeline which we are seriously considering?
So in the private sector, we are working with Oberoi Raymonds, we are working with Brookfield, we are working with all the tier 1 developers. Now their bid pipeline is extremely strong, and therefore we do believe that the private sector gives us a big opportunity. Number two, in the government side, both PMAY, if the existing government comes, they have committed 4 crore more houses to be constructed. So obviously we will be contractors to some of them, and therefore it gives us very huge visibility. Now bid pipeline, I can easily tell you that there will be an opportunity to more than 3 to 4 lakh crore per year for the next 5 years if the construction or infrastructure momentum which has been going on is not tampered with. So therefore, bid pipeline is very strong. It is a time to pick and choose. We have to all understand, you must have seen L&T saying that they are short by 50,000-60,000 labor. Tata Project is also short of labor. So every company is struggling to get adequate number of workmen at the project site. So that is the only challenge which we see when we book projects. Apart from that, we don't see any challenge. It is very simple today to take projects of 6,000-7,000 crore in a matter of 5 or 6 months. But we need to understand that labor is a very, very important resource, and it cannot be trained overnight. And it is still not an organized segment in India. For a small pay increase, they are bound to shift. So therefore, the bid pipeline is very, very strong. However, capacity, as informed earlier, we will be adopting the pick and choose policy, but we are committed to booking orders of 3,000 plus crores minimum in the current financial year.
Got it. And do we have any orders from this Adani Dharavi project?
So Adani Dharavi pre-qualifications are going on. I think there are 4 or 5 bidder contractors who have been sent invitations to submit their pre-qualifications. We are one of them. As and when it happens, we will let you know.
Any tentative timeline that you might have for this?
No, it's a very, very big and a complex project which Adani is executed. So I do believe the railway side of land which is available, that will come up for construction first. But I do not personally have that definitive timeline as I speak to you now. But of course, you can, Amit from our PR team will inform you in a couple of days after discussing with our business development team.
Got it. And so what will be your full year PAT guidance, if you might share with us?
You have seen the Q4 numbers?
Yeah.
Yeah. So you can have your own guidance. It should be a very good year for all of us.
Hopefully, yes. And sir, one last question if I may ask. Sir, a couple of quarters back, we were also seeing we might enter some new cities and some new geographies somewhere is the management planning on something, or is there a talk on the board, or how is it?
So Delhi NCR is definitely on the radar. We have already taken a big order over there. We are clocking revenues in excess of 10 crores per month over there. And we will be taking orders both in the private and public sector in Delhi NCR. So we treat that as one geography, though it may be 3 states or 3, Noida is where we are currently executing. We have bid projects in Gurgaon, which has come up very well, both from pricing perspective and the quality of developers and the quality of contractors. You have also seen some developers from Mumbai getting into Gurugram. So what I believe is that at least for the next 2 quarters to 3 quarters, the company will focus on Maharashtra, Gujarat pockets. We are already doing GIFT City. Last project we lost we were L3 maybe or something like that. We couldn't compete from the price bid perspective. But yes, these 3 geographies will be main geographies for capacity in the current financial year.
All right. I'll get back into the queue, and congratulations again.
Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Parikshit Kandalpal from HDFC Securities. Please go ahead.
Hi Rohit, congratulations on a good quarter, sir.
Thanks. Yeah.
So my question is on, so if you can, as I joined the call a little late, so I'm sorry for repetition. Just wanted to check how much is the total CITCO backlog now, and how much was the execution during the quarter from CITCO?
CITCO backlog is about 3,200 crores, and we have done about 375 crores in the last financial year. We look to do about 600 crores in the current financial year. Location 7 should start by July, and suitable extension for that will be received. So out of 2,400 crores, we have done 800 crores, and we will be doing about 600 crores in the current financial year, and about 750 crores in the next subsequent financial year to complete the scope which we have at the moment in time.
And the second question is all the escalations and price escalations, price variations, now all are like certified by the client?
Completely.
Okay, so my second question is on...
Variations are pending, but that too has been certified in quarter 4 of the current financial year.
Okay. And what will be our strategy on the southern market now? So we had done Brigade project and some projects for Prestige. So how are we looking at the southern markets in terms of business development now?
You see that we have seen an improved realization in Delhi NCR, but we are yet to see an improved realization in Bangalore market. So it is not on our radar. Yes, Hyderabad is coming up with a lot of super high-rise buildings. Again, the entry would depend upon realization. We are very clear that Mumbai, MMR, and Delhi, especially Gurugram and Noida, are giving much better realizations than the southern part of India. So, while we would love to go back there and work, but it will all depend on the realizations. We have been invited to bid by Brigade for Hyderabad project. I do not know what is the current situation on that. But obviously, as you know, over the last 4-5 years, we have graduated into public sector as well. And public sector is one place where we get an opportunity to bid for EPC projects. We are executing 3 to 4 EPC at the moment in time. And now even MCGM, which was earlier BOQ tenders, have now migrated to EPC. That gives a better opportunity to companies like ours to improve upon the efficiencies of engineering and thereby make a better margin. So private sector, southern sector will have to wait for some time until we see some improvement in the margin profile. Private sector, Mumbai, Delhi NCR, we see a strong growth. Public sector across the geographies which we have been already operating in, we will look to focus at opportunities which are presented, and obviously the decision will be taken in perspective of the client quality, and the pricing what we are able to derive from that market.
Thank you. Ladies and gentlemen, we will take that as the last question. I would now like to hand the conference over to the management for closing comments.
I would like to thank all of you once again for joining us on this call today. We hope that we have been able to answer your queries. Please feel free to reach out to our IR team for any clarification or feedback. Thank you and see you next quarter.
On behalf of IIFL Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.